e.l.f. is one of the hottest cosmetic brands in the stock market, showing impressive growth with revenue increasing at an annual rate of 53% over the past 5 years. But despite these strong numbers, the stock is down 70% from its peak and continues to decline. But why? At first glance, the numbers look great, but there is one deeper issue at play, one that makes holding this stock a much riskier move than it seems. I'm talking about the Muddy Waters report, which accuses e.l.f. of financial misrepresentation. They claim the company inflated revenue by up to 119 million over the last 3 quarters. This means revenue should be between 15 to 20% lower based on their assumptions, and their argument? e.l.f.'s import records don't align with its reported sales. If imports have dropped significantly, how is growth still happening? Well, the company insists that their financials are accurate and that the fall in its imports seen from customs data is due to confidentiality requests. So they are calling the Muddy Waters report without merit and based on flawed assumptions. Right now, we can't say for sure who is right, but the stock is falling, and insider selling tells an interesting story. In Q2, insiders sold more shares than they had in years, right in the time of the first major stock price decline. This could suggest they knew trouble was ahead. However, in the Q4, insider selling dropped significantly, maybe because they believe in the company's financials and don't want to sell at these low prices. But who knows? The truth will likely come out only if an investigation is launched. But if that happens, the stock will almost certainly drop further. So if you are considering buying e.l.f. stock, be cautious. Now let's talk about valuation. If the financials are accurate, e.l.f.'s past performance looks strong. Fast growth, expanding margins across the board and positive free cash flow. The only downside? A 4.4% dilution in shares outstanding. Even the core business was profitable for the past 4 years. To analyze its fair value, let's break it down with different growth scenarios. But first, this is not financial advice. Do your own research before buying e.l.f. stock. Okay, we always start with a 0% growth to get our baseline. Then a mid case assumes 10% annual growth, and a high growth case assumes 20%, slightly above analyst expectations for 2026 and 2027. For net income, we use 4, 5 and 6%. For EBITDA, we use 10, 13 and 16%, while cash flow from operations historically averages 63% of EBITDA, so this is how we calculate these numbers. CapEx is assumed at 1.2% across all cases. Now, by adding cash flow from operations and CapEx together, we get free cash flow, which ranges from 52 million to 109 million, with terminal value ranging from 581 million to 1.8 billion. We can now discount all these numbers to today by using 12% return. Now terminal value ranges from 466 million to 1.4 billion. To get our true value, we now add up cash flow and terminal value. But we can go further by adding in cash and subtracting debt, which gives us a stock price range of $7.34 to $27.20. Another valuation method is EBITDA multiple. The company's historical average multiple is nearly double the industry average, due to the past strong performance. To get stock price using EBITDA multiple, we use our projected 2027 EBITDA number and we multiply it by the given average. Then we discount it back to today, and the same as for the perpetual growth, we add in cash and subtract debt, which gives us a price range of $47.58 to $137.13 using the company's historical multiple, and a price range of $16.94 to $52.42 using the industry average multiple. Averaging each EBITDA and perpetual stock price gives us all the stock prices for the company and industry average valuation. If we take the average of all the data we put in, then the stock price should be somewhere between $24.02 for the industry average and $50.97 for the company average. Analysts' expectations suggest a range of $41.16 to $96.86. A third method, where we just multiply the average cash flow from the core business with 20 and add in cash and subtract debt, values the stock at $19.55. While this is very low, this makes sense for growth stocks, since they reinvest in expansion. If you now look at last free cash flow from core business, then the stock price should be valued at around $44. So what's the fair price to pay? If we assume financials are legitimate, I can give you 3 buying scenarios based on what we observed. If you believe the e.l.f. from now on will grow at the industry speed, then you shouldn't pay more than $25. If you believe the growth is there, but it will be slower than in the past, then around $50 is the price for you. If you believe e.l.f. will expand significantly in the next few years, then it's a buy at current levels, as I will put it at $75. But let's not ignore the risk. If the financial misreporting claim is true, what happens to the stock price? More importantly, would you even want to own a company caught inflating its revenue? For me, the answer is no. Once trust is broken, it's hard to rebuild. And with so many other great investments opportunities out there like ADM, which is beaten down because of a food cycle, or Celsius, that also declined significantly and is now much closer to a potential buy. So why take the risk? If you're considering buying e.l.f. stock, be careful. And if you're looking for safer or high growth alternatives, there are plenty to explore. Watch this video next to learn more, and I will see you in the next video.